at the same time, you have, right now that the LBMA is blowing up in terms of running out of stock, you have for the 18th day in a row backwardation between spot and futures. Right now, it's about $1.24. The physical demand is different than I have ever seen. As Bank of America on Monday raised its forecast of silver to 65 per ounce by next year. And Jeffries was the name, Jeffries was a primary distributor for all the major mints. They understand gold. They subsequently got out of the market, sold off the Beige name, and it's just Jeffries. Their head trader is saying $6,600 gold is their next stop. They understand gold. The high lease rates and all of this stuff, the Judy Sheltons of the world, and the Trump saying he who has the gold makes the rules, and Besant saying, I want to remonetize, be part of a new monetary. Keep going. I'll keep going.
Physical silver markets are flashing red, and Andy Schectman believes this is unlike anything he's seen before. The London Bullion Market Association is reportedly running dangerously low on available silver, with backwardation persisting for more than 2 weeks straight, a rare signal that immediate physical demand far outweighs future supply. Meanwhile, major institutions are quietly shifting their tone. Bank of America now projects silver could reach $65 an ounce next year, and traders at Jeffries are calling for $6,600 gold as confidence in fiat wanes. Add to that renewed political talk of gold remonetization, and it's clear that something structural is changing beneath the surface. The message is simple. The world is waking up to real money again, and the clock is ticking. Like, share, and subscribe for more deep insights into this unfolding monetary reset.
India being one of the largest buyers of physical silver, that's a big deal. I think worth certainly mentioning. The managed money is short by over $1 billion on silver, meaning the commercial banks took the other side. I wonder how that's going to play out. I would suspect you'll see silver really start to move this week when the managed money, the dumb money, in relation to the commercial banks, the ones that seem to always be on the right side of the trade until one day they're not. And maybe this is the one day one would expect silver to really start to move higher here right now. I don't like to make those kind of predictions, but I will tell you that this is very unusual to see how short the managed money is. At the same time, you have, right now that the LBMA is blowing up in terms of running out of stock, you have for the 18th day in a row backwardation between spot and futures. Right now, it's about $1.24. This tells you that the people are paying extra to get real silver now, not in the future. This is not bearish. This is a panic for the real metal. At the same time, short sellers are now paying a 19% annualized rate just to borrow SLV shares, where we see a lot of shorting, and a 39% lease rate on the LBMA. This is not indicative of a well-functioning market. Bank of America on Monday raised its forecast of silver to 65 per ounce by next year, with an average of 56.25. Until then, they also lifted their outlook to gold for 5,000. And the last thing that I will say is, and I may have repeated this last week, but for people who haven't heard this, you got 4 or 5 things that are incredibly bullish. You got, as we mentioned before, Morgan Stanley saying no more 60-40, 60-20-20. Get rid of half your bonds, buy gold with the other half. 60% stock, 20 bond, 20 gold. When have you ever heard a financial advisor say 20% in gold? This is from their chief investment officer, their CIO. This guy and the people that I'm about to mention speak to not the plebes, but to the institutional level traders, not to the rest of us. They're saying put 20% of your money in gold and pare down your bond holdings by 20%. Michael Hartnett for Bank of America, this is the one that just said, 60, whatever, $65 on silver. Michael Hartnett's newsletter, I don't know how much it is, but I bet it's 10 grand a year. He just came out and said, no, it's 25, 25, 25, 25. 25% stock, 25% bond, 25% short-term treasury, and 25% gold. Whoa. Then you get Jeffries. Now, as you mentioned at the onset of this meeting, we were blessed by Prudential Beige about 20 years ago, and they nominated us. The authorized resellers, the 6 or 7 of them, can nominate one primary reseller, the primary distributors can authorize one authorized reseller. And they did. Prudential Beige authorized us or nominated us to be an authorized reseller, one of 27, about 2 decades ago. God bless them for that. Walter Pahowicz, if he's still out there, Walter, I love you. He used to run their desk. They got bought by Jeffries, and Jeffries Beige was the name. Jeffries Beige was a primary distributor for all the major mints. They understand gold. They subsequently got out of the market, sold off the Beige name, and it's just Jeffries. Their head trader is saying $6,600 gold is their next stop. They understand gold. But maybe the biggest of them all is Jeffrey Gundlach, the bond king, the man who's made his mark, his fortune, and his moniker of being the bond king by selling bonds, who just came out and said a 25% portfolio allocation to gold is not overweight. Really? So when you see these people at these levels, and then put into it all the stuff coming into COMEX and the draining on the LBMA and the high lease rates and all of this stuff, the Judy Sheltons of the world, and the Trump saying he who has the gold makes the rules, and Besant saying, I want to remonetize, be part of a new monetary. I mean, keep going. I'll keep going. And I'm telling you, and I hate to say it, I cringe saying it, but this time it's different. And look at gold. Got the snot kicked out of it by over $100 last week on Friday. And what are we at today? We're up $108 right now as we speak. The physical demand is different than I have ever seen, as are all of these things. People at that level speaking to institutional traders at that level saying 25% allocation is good. Never seen that before, man. Not even close.
The silver market appears to be entering a historic inflection point, one defined by scarcity, structural stress, and unprecedented institutional endorsement. Physical supplies on the LBMA are thinning rapidly. Backwardation has persisted for nearly 3 weeks, and short sellers are paying extreme premiums just to borrow metal. This isn't normal market behavior. It's a sign of panic for the real thing. At the same time, major financial voices are openly rethinking portfolio construction. From Morgan Stanley's 60-20-20 allocation model to Jeffries' $6,600 gold call and Bank of America's $65 silver forecast, even Jeffrey Gundlach, long the face of the bond world, now says a 25% allocation to gold is not overweight. Add to that Trump's own call to remonetize gold, and the message is clear. Something fundamental is breaking beneath the surface. Let's get into the interview.
The systemic nature of it. We could look at the problems at the LBMA as an example. All we keep doing is focusing on the LBMA and what happens if there is a silver failure to deliver by one of these massive banks. These are all commercial banks. Well, if a bank fails in silver, fails to deliver, the systemic reaction, the contagion, would spiral through everything, because they're not just bullion banks. They're banks that have their fingers in all of the other financial pies. The same thing is true here, and that you see one of these banks and you start to see problems with commercial loans. Not only that, you have what's called credit default swaps, where in essence, you're buying insurance against this stuff. And this is why AIG had to get bailed out. If it gets bad enough and you start to see big banks fail because of, bankruptcies, which are non-recourse in commercial real estate, and you just see this cascading effect. Now, we haven't seen it yet, but logic would dictate that we might. Right? Who's going back to the office? And it's the opposite of that. Who knows where this leads? And this is when you see people start to pull out of regional banks, and the regional banks are the ones in big trouble, in my opinion, because of this exposure. So, yeah, I think that this is why you see assets like gold and silver and cryptocurrencies like Bitcoin being purchased, because people are trying to get away from the potential for a systemic contagion that's out there. And this is a good example of how it could happen. And if the Fed wasn't concerned about it, well, they'd be a little bit more open about it. The fact that they're so hush-hush reminds me of the FDIC saying, well, if the public really knew, they'd freak out. Remember, we showed that video a year or two ago. It's the same thing, and it's just more of the same thing. That's why people like you, I always say it, are more of a real source of information and news than the media, which is more about divisiveness and entertainment, if you want to call it that. It's not about understanding what's really happening. And John, Rubino, and Alistair, they're spot on. This is a problem that has not yet resolved itself, not even close.
What's unfolding in the global banking system isn't just another liquidity issue. It's a structural fracture that could ripple through every corner of finance. The cracks at the LBMA are only a symptom of something far deeper. A system overloaded with leverage, derivatives, and opaque interconnections. If even one major bullion bank fails to deliver silver, the contagion wouldn't stop there, and it would spill into commercial loans, credit default swaps, and the broader banking network that props up the modern economy. The parallels to AIG's collapse are chilling, except this time, the exposure is far wider and the safeguards far weaker. As regional banks wobble under the weight of commercial real estate losses, investors are quietly retreating to gold, silver, and Bitcoin, not as speculation but as protection. The silence from policymakers speaks volumes. The system knows it's fragile. The public just hasn't realized it yet. Like, share, and subscribe for more critical insights.